Welcome to Banking 101, a first principle jargon-free course on banking. In this lesson we will continue our discussion on asset management products with focus on asset servicing products. In the previous lesson, we learnt that asset management products can be categorized into investment management and asset servicing. We covered investment management in the previous lesson. We will cover asset servicing in this lesson. At this point, it is also worth reminding ourselves of something we learnt in the previous lesson. Assets are managed by either asset owners or third parties acting as their agent. The scope of our lesson is only the asset management functions performed by these third parties. And within that, we are concerned with the asset management divisions of banks. We reviewed this graphic in the previous lesson and learnt that asset servicing products come into play after an investment decision has been made. These products support trade execution, trade settlement and ongoing servicing of ownership positions. The processes underlying settlement and position management are also sometimes referred to as post-trade. The customers of asset servicing products are either investors or issuers of equity and debt capital. Investor and issuer servicing are sometimes antipodal perspectives of the same underlying function. For example, a servicer on the investor side receives dividends on behalf of her clients while a servicer on the issuer side is responsible for paying out dividends on behalf of her client. We will now map the catalog of asset servicing products against the last three steps of the investing process. The foundational investor servicing product is securities brokerage that allows customers to trade. Settlement services facilitate the settlement of trades executed by brokers on behalf of their clients. Traders may be borrowing cash or securities for the purpose of settling their trades. Financing services refers to products that facilitate such financing. Once trades are settled, custody services refer to the maintenance of ownership records of financial assets. Corporate actions processing refers to processing of actions initiated by issuers of capital on behalf of investors. Examples include receiving dividend and interest payments. Fund services are a bundle of services that address the needs of fund sponsors like mutual fund and hedge fund managers. Finally, on the issuer side, transfer agents facilitate communication between issuers and investors for equity issuers while trust and agency business caters to bond issuers. The rest of this lesson is centered around understanding these products. We will begin with investor servicing products. Securities brokerage is the foundational product that allows investors to trade. We can break securities brokerage services into two sub-products. At the base level is a brokerage account. Trade execution services are tied to this. Next, we will look at each one. We are all familiar with bank accounts. While bank accounts store fiat currency, brokerage accounts can store fiat currency as well as other financial assets, including stocks, bonds and mutual funds. Tax-advantaged retirement accounts are special types of brokerage accounts. In the United States, common retirement account types are 401k and IRA accounts. Brokerage accounts are of two types. Cash accounts are accounts where an investor must have sufficient funds to purchase securities. Additionally, the investor cannot sell securities she does not own. In a margin account both are permitted. Historically, broker-dealers have offered margin accounts to high net worth and institutional investors. But fintech brokerage firms opened up margin accounts to retail investors. We will learn about margin lending shortly. Brokerage accounts themselves would not be very useful if we could not trade through them. To trade securities on behalf of clients, typically an entity has to get a license from the securities regulator of the country. Once a client initiates an order, as we saw in the lesson on trade lifecycle, the transaction can be routed by the broker to an exchange, a digital platform or traded OTC. Some assets like bonds are not listed on an exchange. But even for an exchange-listed stock, the broker is not mandated to route the order to an exchange as long as he is offering best execution terms to clients. Broker-dealers are of two types. Discount brokerage firms are focused on retail investors. Their immediate client could be the retail investor or a financial advisor who is trading on behalf of the retail investor. Examples include Robinhood and Charles Schwab. Full-service broker-dealers provide trade execution services to institutional investors like hedge funds, pension funds and insurance companies. These full-service broker-dealers sit within the investment banking divisions of big banks like J.P. Morgan and Citibank. They provide a broader suite of service than discount brokerage firms. We will learn more about them in the next lesson on investment banking. The next asset servicing product that we will discuss is settlement processing. We had reviewed settlement processing in the previous lesson. Hence, we will merely summarize here that the custodian facilitates the settlement of trades via accounts held with the CSD. The seller's custodian ensures that there are sufficient securities with the CSD on settlement date, and the buyer's custodian ensures there is sufficient cash. Many discount brokerage firms offer this service to their clients instead of using a third-party custodian bank. We have seen earlier that in the modern system of trading, an investor does not need to own cash or securities on the trading date as long as she can fulfill the payment or delivery leg of the trade on settlement date. Financing services refers to cash loans being made to buyers and securities loans being made to sellers, so that they can fulfill their settlement obligations. Collateral management is an ancillary service tied to these financing products. We will next look at each one in turn. A margin loan is a loan made against the value of securities owned by the borrower. Margin lending is of two types. One is for purchasing new securities, where the securities purchased is held as collateral. The second type of margin loans are made to finance expenditures against the collateral of securities that are already owned by the borrower. In either case, the loan is capped at a certain percentage of the value of securities owned. We will next look at example of each type. In the example shown, an investor buys $10,000 worth of securities. The maximum permissible loan the lender has agreed to advance is 20% of the market value of the securities. So, the borrower pays $8,000 and $2,000 is lent by the margin lender. After the purchase, if the value of the securities collapse, the investor would be out of compliance with the 20% condition. In this circumstance, the lender will ask the investor to deposit cash or additional securities to make up for the value shortfall. This is termed a margin call. The lender also has the right to sell the securities to recover its cash, in case the borrower does not meet the margin call. Broker-dealers are often big margin lenders, especially to their institutional clients. Margin loans can also be used against the collateral of securities already owned by the borrower. Margin lending is often used by high net worth individuals for purposes that could vary from financing lifestyle expenses like travel, buying physical assets including real estate and education. Margin loans collateralized by existing securities can also be used to buy new securities or even fund acquisitions. Margin borrowers may prefer to pay interest on loans by pledging securities as collateral over losing potential market gains and paying capital gains tax incurred on selling securities. We reviewed the workflow of securities lending in a previous lesson. Hence, in this lesson, we will focus on the role played in securities lending by asset management industry participants. On the lending side are investors who own securities. This includes principals like endowments and sovereign wealth funds. Lenders can also include principal intermediaries, mainly pension funds and insurance companies. Mutual fund managers can lend securities that are held within their funds. What is common to these lenders is that they hold assets for longer durations and can earn an additional yield on their assets. On the borrowing side, the major borrowers are hedge funds who often deploy short-selling strategies. Selling securities short without at least initiating a request to borrow the securities is called naked shorting and is illegal in many countries. Broker-dealers also borrow securities to fulfill buy orders from their clients. While the lenders can directly lend to borrowers, the industry typically relies on intermediaries. While securities owners can directly lend to borrowers, it is common for custodians to facilitate securities lending on an agency basis. This is because their clients often include both lenders and borrowers, thus they can play a matchmaking role, even though they don't own the securities. Similarly, on the borrowing side, broker-dealers often intermediate the securities borrowing by borrowing securities on behalf of their clients. For example, hedge funds rely on their brokers to deliver the securities they are shorting. Many securities lenders may not wish to directly lend to a hedge fund as they perceive a lower credit risk from the broker-dealer. We are familiar with physical assets acting as collateral. In a mortgage, if we default on our home loan, the lender can possess our home. Similarly, the car is the collateral in a car loan. Financial assets, like physical assets, can act as collateral. The simplest form of financial asset, which acts as collateral, is of course cash. But any financial asset can act as collateral for a loan. In previous lessons, we learned about mortgage-backed securities where individual home loans form the underlying collateral, the proceeds of which are used to pay investors. The home loan acts as both a cash flow generating asset as well as collateral for investors in the securitization vehicle. In margin loans, we saw that securities are used as collateral to facilitate trading. In securities lending transaction, which we just reviewed, the loan is in the form of a security, while the collateral is often cash but could be securities also. Earlier, we also learned about a repo transaction where securities were used as collateral to borrow cash. Collateral management services refers to the maintenance of the underlying financial asset collateral. Let us look at some activities. At the foundational level, The collateral manager provides custody of the underlying collateral. Imagine you lent cash and have taken securities as collateral. You would not want the borrower to be able to sell the securities without paying you. A third party, like a custodian bank, can ensure that the securities have been tagged as collateral and cannot be sold during the loan tenure. Collateral management also involves receiving principal, interest and dividend payments on the underlying financial asset and paying it to the correct party. Whether these payments go to the lender or the borrower depends on the contractual agreements. Another activity is valuation. The value of securities can change on a daily basis. The collateral manager must update the collateral values to reflect current market prices. This is called mark-to-market. Linked to valuation is administration of margin calls. Imagine the value of the collateral goes down significantly. The collateral manager can ask the borrower to post additional collateral, failing which she can start selling the securities to repay the lender. These activities are not an exhaustive list, but this should give you a good idea of the nature of collateral management. Custodians are natural provider of these services since they maintain the detailed ownership records of securities. So far, we have covered 3 asset servicing products that facilitate the execution and settlement of trades. Brokerage and settlement services enable ownership transfer of financial assets to occur through trades. Financing products allow investors to use debt to finance their trades. Once a trade has been settled, several asset servicing products are required to manage the resulting ownership positions. Let us turn to them now. We will begin with custody. We have learned about the role custodians play in facilitating settlement of trades. Additionally, the second key role they play is provision of custody. Next, we will explore what custody means. The understanding of custody as a product in the context of financial assets is easier when we think of financial asset in physical forms. For instance, holding a paper share certificate in a physical lockbox. We can expand our understanding of custody to a world where ownership records are in bookkeeping form. Custody can thus be defined as maintaining the golden ownership record of a financial asset in bookkeeping or physical form, in a safe and secure manner. We use the term golden ownership record, as well as safe and secure, in the context of custody. Let us explore these concepts with examples. The term golden record of ownership implies that the record acts as proof of ownership that others accept. While selling our house, we can prove that we own the house by pointing to a government database that maintains the golden ownership record. The public agency acts as a custodian and ensures that someone does not hack into its database to tamper with ownership records. Proof of ownership of a crypto token like Bitcoin is evidenced by knowledge of a private key corresponding to the blockchain address where the token is stored. In the crypto ecosystem, individuals can choose to maintain custody themselves instead of relying on a government entity or a financial institution. Individuals can maintain their private key themselves by simply writing it down somewhere or digitally, within a crypto wallet. The most common custodian of our financial assets is the bank where many of us keep our savings. However, core banking assets like demand and time deposits are not traded. Financial assets like stocks and bonds trade frequently and hence, need specialized custodian abilities. As we learnt in a prior lesson, the golden record of ownership for many financial assets that are traded in capital markets is maintained by the CSD. However, investors typically don't own a direct relationship with the CSD but rely on a custodian. The custody service offered by custodians effectively refers to the reconciliation of their clients' positions in the custodian's books with the books of CSDs across the globe. Custody services could be offered by specialist custodian banks like BNY Mellon and State Street Global or the asset management arms of big banks like Citi. Many retail brokerage firms also perform the custody function for their clients. We discussed in the lesson on the trade lifecycle, there is a chain of participants who hold custody of securities. Investors can have self-custody, if they are holding on to paper share certificates at home. However, in most countries, paper certificates have been dematerialized. In the crypto ecosystem, holding one's own private key is an example of self-custody. However, self-custody is not common in securities. The broker-dealer, the custodian and the CSD maintain ownership records in a chain. Broker-dealers and custodians maintain custody in segregated accounts for investors. The CSD usually holds in omnibus accounts where each account belongs to a CSD participant, like a broker-dealer or custodian. You can revisit these concepts in the earlier lesson on trade life cycle. Custodians hold 2 principal asset types: cash held in bank accounts and securities held in what are known as safekeeping accounts. Cash refers to the idle cash that clients end up holding with custodians in anticipation of trade settlements. If the custodian is a chartered bank, they are able to offer bank accounts themselves. Otherwise, the custodian will ask clients to deposit cash in a third-party bank. The custodian earns income on these idle cash balances by investing them in very safe instruments. However, once the cash is converted to securities, the securities are not held on the custodian's books. Rather, they are held on behalf of the client. These are assets under custody as opposed to assets under management. The wording indicates that custodians don't make investment decisions. Corporate actions are actions undertaken by issuers of securities that impact the owners. We can put them into two broad groups: benefits and corporate reorganizations. Benefits refers to events like payments of dividends and interest. Corporate reorganizations alter the holdings of the securities owner. A company whose share price is $1,000 may do a 4-for-1 split, so that the price of an individual share falls to $250. A company may want to do this to allow retail investors to easily buy the stock. Similarly, when Company A buys out Company B shareholders are given the choice of a cash payout or exchange their old shares with the shares of the new entity. To illustrate how custodians process corporate actions, let us take an example of a company like Apple that issues a dividend. Apple deposits a consolidated amount with the CSD for all the shareholders registered with that CSD. The CSD then allocates the dividends to its participating members, which are mostly custodians and broker-dealers. The custodian then allocates the dividend among its clients. In scenarios where securities are heavily traded, this could be more complex than it sounds. For example, if a trade occurs on dividend payment date but the trade is not settled yet, who gets the dividend? The buyer or the seller? Custodians have the specialized knowledge of market practices across geographies to make these determinations. The custodians also provide economies of scale. In this illustration, multiple clients of the custodian have a position in Apple. Since the custodian is processing the dividend for multiple investors, they can do it more efficiently than if these investors were processing corporate actions individually for themselves. While this illustration is shown for dividends, this is true conceptually for any corporate action. We have repeatedly encountered funds that pool savings of multiple investors and invest in assets. Mutual funds and exchange-traded funds are generally open to all investors. Other funds like venture capital, private equity and hedge funds are more oriented towards institutional investors. While corporate actions are processed at the level of individual securities, fund services are processed at the fund level. Custodians are often providers of these services. Fund sponsors require tracking of ownership as investors buy and sell out of the fund. They also need valuation services. Consider a mutual fund that has invested in hundreds of stocks. Every day the price of an individual stock within the fund could change. How would that change the valuation of the mutual fund? Further, if a fund holds illiquid assets like equity of private companies and real assets, how should they be valued? Accounting and valuation services deal with these issues. Investor reporting refers to the production of fund performance data for fund investors. When we invest in mutual funds, we are able to see such performance data through our broker's website. Institutional investors have more sophisticated reporting requirements. Finally, other administrative services is a catch-all category that covers a wide range of activities ranging from preparing reports to be filed with regulators to paying fund expenses to vendors. This concludes our discussion on investor servicing products. We will now turn to asset servicing products that are issuer-facing. So far, we looked at asset servicing products that meets the needs of investors. We will now turn to issuer-facing products. Issuers are the private and public sector entities that are raising capital by issuing securities. The two major products we will cover are transfer agency and corporate trustee services. Let us turn to each one. Before we learn about transfer agents, we will learn about shareholders. The shareholders of a company are of two types: registered shareholders and beneficial owners. Registered shareholders are those who directly purchase shares from the company and the shares are registered under their name. This may be founders or employees who have been granted stocks as compensation. Even investors who bought shares from a brokerage firm can get their shares registered with transfer agents. The vast majority of shareholders in public companies are beneficial owners. Their ownership is registered with the issuing company under the name of the CSD. The beneficial owners could be individuals, businesses, or fund legal entities. The transfer agent performs record-keeping duties for the share-issuing corporate. It maintains the total number of shares that were authorized versus the number actually issued. These numbers change only occasionally, for example at the time of a merger or a stock split. The transfer agent also tracks shareholders. For beneficial owners, the transfer agent only tracks the number of shares held with CSDs around the globe. Another major area of responsibility of transfer agents is to make dividend payments on behalf of the corporate. They make payments directly to registered shareholders, but for beneficial owners, the funds are simply placed with the CSD from where funds flow to beneficial owners. Finally, transfer agents are also responsible for shareholder communications. These relate to corporation actions as well, communications specific to events like the annual shareholder meeting. While transfer agents are commonly associated with stocks, they can perform those duties for any type of securities. But for debt securities like bonds, typically, these services are bundled together within the corporate trust service and provided by an entity called the trustee. The trustee is responsible for administering the contractual terms under which holders of the debt security, like bondholders, lent to the issuing entity. Even though we are discussing corporate trust services as part of issuer-facing products, in reality this is a two-sided role serving both issuers and investors. Let us look at each side. On the issuer side, the role is very similar to transfer agents and hence we won't rehash it here. The key thing to note is that on the issuer side, the trustee is accountable to the issuer for service quality. If the trustee was not providing good service to investors, the investors, in turn, would complain to the issuer. The duty towards investors are more complex. A critical activity included in this is monitoring compliance with the conditions under which the bonds were issued. An example could be restrictions on issue of additional debt by the corporate, since that creates more risk for existing bondholders. The trustee calls an event of default if the issuer violates a debt condition, including non-payment of principal and interest. The trustee plays a lead role in mediating a resolution in case the borrower defaults and acts in a fiduciary capacity on behalf of investors. An additional level of complexity in the role of trustee comes when the debt security under consideration is an asset-backed security. In earlier lessons, we had seen the example of mortgage-backed securities. In modern finance, the underlying asset producing cash flow can be varied, including different types of consumer and commercial loans. Trustees receive the cash from the underlying assets and distribute to investors. While this activity is conceptually the same as for bonds, there is greater complexity in segregating principal from interest and paying out at different rates to different categories of investors. At this point, we have covered what asset servicing is. But who are the main industry players? This is an industry where scale matters because there are a lot of fixed costs. Hence, the larger the assets being serviced, the lower is the cost as a percentage of assets. The industry consists of pure-play retail brokerage firms, banks that are known for their asset servicing specialization, the asset servicing arms of full-service banks, transfer agents and other specialist firms. We covered a lot of ground in this lesson. Asset management is a vast topic. However, within the context of a Banking 101 course, this lesson and the previous lesson was designed to give you a solid foundational understanding of an important product line offered by many banks. We can now create a two-dimensional map between roles on the horizontal axis and products on the vertical axis within asset management. The principal roles that serve investors are investment advisors, broker-dealers and custodians, including central custodians. In addition, issuers are served by transfer agents and trustees. Many of these roles can be performed by divisions of the same entity. For example, many broker-dealers also offer custody. Hence, we should not confuse roles with entities. On the vertical axis are the investment management and asset servicing products that we just reviewed. Investment advisors, as we saw, sell advice. Some also advise pooled investment packages like mutual funds and hedge funds. In addition, fund sponsors can lend securities within their portfolio to earn additional interest. Broker-dealers, apart from core brokerage services, borrow securities from their clients or their peers and lend them onwards. Custodians offer two core functions. First, they facilitate settlements and have custody of securities. They also facilitate lending of securities in their custody. In addition, they process corporate actions on assets under their custody as well provide fund services to clients. Finally, transfer agents and trustees service issuers of capital. This brings us to an end to our lesson on asset management products. Review the summing up section of this lesson before proceeding to the next lesson.